Okay, let's dive right into this one. Welcome to Iron Financial, the explainer, where we do the heavy lifting to help you forge a stronger, more resilient portfolio. We're here to cut through all the market noise, stress test the balance sheets, and figure out which assets actually have a solid foundation and which ones are, well, structurally compromised. Today, we are putting Shopify's Q1 2026 earnings under the absolute microscope. And look, right out of the gate, we are talking about massive, unprecedented scale here. We're talking about a unified commerce platform that just pushed over $100 billion through its pipes in a single 90-day quarter.
Yeah, okay, but let's be real for a second. Let's look at the actual price action. If this foundation is so incredibly strong, if the rebar is so thick, why is the stock bleeding out? Why did the market punish this company so aggressively right after they posted these supposedly ironclad numbers? I mean, is this just a classic tech hype story that's finally starting to show some serious cracks in the armor? Or is the market just totally mispricing the underlying asset? We really need to drill down into the absolute truth of these financials today.
We absolutely do, and we'll get to the stock price, I promise. But we have to start with the absolute bedrock of the entire Shopify thesis, the sheer velocity of their commerce engine. Gross merchandise volume, or GMV. It hit an astounding $100.7 billion in the first quarter alone. That, by the way, is a 35% year-over-year growth rate. Just think about the heavy lifting required to process that kind of volume securely. We aren't just looking at a simple website builder software company anymore. We are looking at the foundational infrastructure of global e-commerce. To put that into perspective, they are processing more trade in 3 months than the entire annual GDP of dozens of nations. This right here proves extreme platform durability. They've completely cemented themselves as the underlying rail system for independent retail.
Look, I don't disagree that $100 billion is a massive number. It absolutely shows phenomenal merchant velocity. But as we always say, GMV isn't revenue, and it definitely isn't profit. It's just the gross amount of money changing hands on top of their software layer. As an investor, I want to know how much of that capital is actually sticking to Shopify's own bottom line, you know?
And really, that brings us to the ultimate question we have to answer for the folks watching today. If $100.7 billion in GMV is such a structural flex, why in the world did the stock drop 7.3% immediately after this print? We're looking at a stock that was sitting up near $127, heavily priced for absolute perfection, and the market just threw it right into the penalty box. So the crucial point for us today is this. For the retail investor who is just trying to build a resilient long-term portfolio, is this massive pullback a total valuation trap that you need to avoid, or is this the ultimate buying opportunity?
It's a fair question, but to answer that, we have to stop looking at emotional day-to-day price action and start looking at the actual structural integrity of the balance sheet. Let's look at the top-line numbers and see exactly how this thing builds out.
Now, this table right here brilliantly illustrates their operational leverage. Looking at the Q1 2026 column, overall revenue came in at $3.17 billion, which is a 34.3% beat year over year. So they are capturing the value of that GMV growth almost perfectly, one-to-one. But the most important number anchoring this entire board, the true measure of structural integrity, is that operating income. Look at that, $382 million, representing an 88% surge compared to Q1 of last year. They aren't just growing the top line, they are doing it with radically improved efficiency. The revenue is growing fast, but their operating expenses are staying relatively flat. And what that means is that every new dollar of revenue drops significantly more weight right to the bottom line.
Okay. Revenue is up, operating income is up. But come on, you're cherry-picking the non-GAAP adjusted numbers to make the foundation look spotless. If we are looking at the real, audited GAAP financials, the ones the accountants sign off on, there is a gaping hole in the floorboards.
Just look at this comparison. You are out here touting a $382 million operating profit, but the official GAAP net income for the quarter was a catastrophic loss of $581 million. I mean, that is a massive, massive loss. A structurally sound company doesn't print a $500 million net loss while supposedly firing on all cylinders. So what's going on here? Is it aggressive stock-based compensation just diluting shareholders to death? Are they incinerating cash on bad venture capital investments? Where exactly is the leak in the plumbing?
And it's completely misguided if you actually sit down and read the 10Q filing. Let me show you exactly where that GAAP loss came from, because honestly, it has absolutely nothing to do with their core commerce engine.
Now, look directly at this specific line item from the condensed consolidated statements of operations. Right there, halfway down, net unrealized loss on equity and other investments, to the tune of $1.064 billion.
Let's be very clear, this is a paper hit. Shopify holds strategic equity stakes in other publicly traded companies, like Affirm and Global E, right? And GAAP accounting rules force Shopify to mark those investments to market every single quarter. When the broader tech market fluctuates and those partner stocks drop, Shopify has to take a non-cash, unrealized loss on the chin. If you simply strip away this pure paper volatility, their real net income was actually a positive $360 million, up 59% year over year. The core operations are not bleeding cash at all. They are an absolute fortress.
All right, fair point. I'll concede that. It's an accounting illusion based on their investment portfolio. But to understand the true strength of that underlying fortress, we have to look at what's actually holding the roof up day to day. Where is the actual cash coming from?
Absolutely. Let's unpack the load-bearing pillars of this business model. Shopify essentially has two massive revenue engines driving the whole machine. You have subscription solutions, making up 24% of the mix, and merchant solutions. Now notice the massive weight on the right side of this equation. Merchant solutions is carrying 76% of the total load. The structural shift over the last few years has been profound. You see, Shopify used to be a pure software-as-a-service company, where you just paid a flat monthly fee to build a digital storefront. Now it's an infrastructure layer. Their revenue relies heavily on merchant success and transaction velocity. Quite simply, they win when their merchants win.
Right. But let's pause there, because 76% of their revenue being tied to merchant solutions, that is an enormous dependency on a single pillar. If global consumer spending cracks under the weight of high interest rates and inflation, that 76% is going to take a massive, immediate hit. So what exactly is driving that $2.4 billion in merchant solutions revenue?
Well, that $2.42 billion in merchant solutions is actually up 39% year over year. It is drastically outgrowing the core subscription business. And you're completely right. It is directly tied to consumer spending, but it's also tied to Shopify's ability to extract more value out of every single transaction, what we in the business call the take rate. They aren't just hosting websites anymore. They are processing the payments, they are providing the working capital business loans, and they are handling the complex shipping logistics routing. They are monetizing almost every single step of the commerce lifecycle, creating multiple incredibly sticky touchpoints for revenue generation on every single sale that happens on the platform. Let's look a little closer at the mechanics of this heavy lifting. The absolute crown jewel here is Shopify Payments. Penetration just hit a record 67%. What does that mean? It means out of that $100.7 billion in total GMV we talked about, $67.1 billion was processed directly through Shopify's own proprietary payment gateways. And every single basis point of penetration adds direct structural strength to the bottom line because they capture a significantly larger slice of the processing fee than if a merchant used a third party. On top of that, they are aggressively expanding their lending and risk management services, essentially offering cash advances directly to merchants based on their sales data.
Okay, I understand the share volume play there. But what about the SaaS side? The recurring subscription revenue is what typically commands those massive premium valuation multiples in the tech sector. Transaction revenue is inherently lower quality and far more cyclical. How is the foundational subscription pillar holding up under all this?
The subscription side is rock solid. No cracks there. It pulled in $750 million, which is up 21% year over year. But the real story, the thing you really need to pay attention to here, is monthly recurring revenue, or MRR. That climbs 16% to $212 million. And this isn't just mom and pop shops signing up for a basic $39 a month plan anymore. This growth is being heavily driven by much larger enterprise-grade brands migrating over to Shopify Plus. We're talking about massive, multinational companies finally moving away from their clunky, incredibly expensive legacy custom tech stacks over to Shopify's modern, composable architecture. That enterprise traction provides a very stable, highly predictable cash flow floor that essentially keeps the whole structure from sinking during retail downturns. But we do have to be brutally honest about the margin profile of these two pillars. If you look closely at the cost of revenues lines in this filing, you see where the friction is. While Merchant Solutions is growing much faster and generating the lion's share of the total revenue, it inherently carries much lower profit margins. Why? Primarily because of the hefty third-party network fees paid out to the likes of Visa and MasterCard, plus the actual capital costs required to fund their merchant lending programs. The subscription side, however, is a classic high-margin software business. So as Merchant Solutions becomes a systematically bigger piece of the overall pie, it naturally applies this gravitational pull, dragging down their overall gross margins. And that is exactly what Wall Street worries about. Margin compression. It's the silent killer. You can grow top-line revenue all day long, but if it fundamentally costs you more and more to service that revenue, your actual cash flow is going to suffer. So, cut to the chase. What is the actual cash flow situation after all the bills are paid, the servers are running, and the dust settles?
The cash flow is phenomenal, truly. They printed a 15% free cash flow margin totaling $476 million for the quarter. Remember the massive 2025 restructuring when management made the brutal but ultimately necessary decision to strip out the entire logistics business and drastically cut headcount? Well, this 15% margin proves that the restructuring actually worked. They have successfully delivered durable profitability. They aren't just burning cash to buy revenue growth like they used to in the pandemic days. They are generating massive amounts of free capital natively from their core operations, capital that they can deploy defensively or offensively depending entirely on market conditions.
Okay, I'll admit generating $500 million in free cash in 90 days is pretty ironclad. But let me stop you right there. You've painted a picture of an absolute fortress. High GMV, exploding operating income, enterprise growth, 15% free cash flow margins. It all sounds great. So I have to ask you again, if Q1 was so fundamentally flawless, what exactly spooked the smart money into a 7.3% sell-off? The market doesn't panic for absolutely no reason, especially on a stock with this much heavy institutional ownership. There has to be a crack in the armor somewhere. What is the elephant in the room that we're missing? Lead analyst, the crack in the armor, at least according to Wall Street, is the Q2 2026 forward guidance. Management laid out their precise expectations for the next quarter, and the market didn't love it. They are forecasting revenue to grow at a, quote, high 20s% rate. Gross profit dollars are expected to see mid-20s growth. Operating expenses should hold relatively steady at 35 to 36% of revenue, and the FCF margin is expected to remain in the mid-teens. High 20s revenue growth? Boom, there it is. That's the crack. You literally just showed us Q1 revenue growth of 34.3%. And now they are guiding for high 20s. That is a material deceleration. And we both know that in the tech sector, when a high multiple growth stock shows any kind of sequential deceleration, the multiple compresses violently. So my question is, does this deceleration mean the global consumer is finally wobbling under inflation? Or is Shopify's aggressive international expansion starting to drag down their overall ability to extract a high take rate? It's really a combination of structural mix shifts, and honestly, you hit the nail on the head regarding international expansion. That's the key. Let's look at the geographic data to see exactly where this margin pressure is originating from. The geographic data here is super revealing. The US is obviously still the primary engine driving the train, but notice Europe. It now represents 21% of total revenue, generating $653 million, and it's growing incredibly fast. Now, international markets are absolutely critical for expanding Shopify's long-term total addressable market. But here's the structural reality of the situation. These international regions typically carry an inherently lower take rate than North America. So as international GMV grows faster than domestic GMV, it mathematically applies downward pressure on the blended take rate and their overall gross margins. Basically, they're trading a little bit of near-term margin for a massive long-term global footprint. Right, but it's not just take rate compression that has people worried. If you dig deeper into the expenses, there are some serious red flags forming. Look at this. Transaction and loan losses surged 55% year over year to $116 million. That's a direct result of them aggressively pushing more merchant cash advances and Shopify capital lending products. Are they taking on subprime risk just to artificially maintain this growth velocity? Add to that the incredibly heavy R&D spend they're pouring into AI features like Sidekick and Magic. Is this aggressive CapEx cycle going to just totally destroy the margin expansion they literally just fought so hard for in 2025? See, I don't see that as a red flag at all. I see it as pouring thick concrete for the next decade of growth. Listen to CFO Jeff Hoffmeister's perspective on this exact issue. He explicitly stated, quote, "That is the platform compounding. The durability of this model allows us to invest strategically in growth." End quote. Because they have the structural free cash flow, they can easily absorb a $116 million loan loss provision and massive AI compute costs without even breaking a sweat. Investing heavily in AI tools and advanced enterprise features right now is exactly what secures the platform's absolute dominance against competitors over the next 5 to 10 years. And look, if you want the ultimate proof that management actually believes their own numbers, look no further than this. They just announced a brand new $2 billion share repurchase program. You absolutely do not authorize a $2 billion buyback if you are genuinely worried about the quality of your loan book or the durability of your profit margins. This is management signaling an unshakable balance sheet. They are weaponizing their free cash flow to buy their own stock at a massive discount. They are looking at Wall Street selling off the stock on these short-term deceleration fears, and they are just smiling and saying, great, we'll buy it ourselves.
So, zooming out, it really all comes down to a battle of narratives, doesn't it? The valuation trap versus the durable engine. On one side of the ledger, you have the very real multiple compression risks, the slowing top-line growth guidance, the margin pressure from that international expansion, and those rising loan losses we talked about.
Exactly. But on the other side of the ledger, you have this undeniable, unstoppable structural momentum. You have $100.7 billion in quarterly GMV, massive operating leverage, pristine 15% free cash flow margins, and a $2 billion buyback acting as a massive backstop. Wall Street is agonizing over a few percentage points of growth deceleration in a single quarter, and they are completely missing the fact that the underlying infrastructure is compounding at a terrifying scale.
So, here is the final Iron Financial verdict. Build or bail. If you are a short-term trader trying to play earnings roulette, sure, the take rate compression and the guidance deceleration might chop you to pieces. But if you're actually constructing a long-term, structurally sound portfolio, Shopify is a foundational asset. The cracks Wall Street sees right now are completely superficial. The core load-bearing pillars, Shop Pay penetration, enterprise MRR, and massive free cash flow generation, those are made of solid iron.
You know, it's a bold call, especially with the stock taking a hit. But looking at the actual data, that $100 billion in GMV and that 15% cash flow margin, it really makes it hard to argue against the long-term durability of the platform.
Exactly. The post-earnings sell-off isn't a structural failure. It's a rare window of opportunity to build a position in what is quickly becoming the definitive operating system of global commerce, which leaves us with one final, very important question for you to weigh against your own portfolio. In a world where every single retailer must digitize to survive, are you really willing to bet against the company that's building the very roads they have to drive on? Think about it. Keep your portfolios forged strong, everyone. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.